Hello everyone, Warren Buffett here, glad to be with you again. Today I want to talk about one of the most crucial secrets in investing, a secret that's helped build Berkshire Hathaway to what it is today. Many believe finding good stocks requires complex formulas or real-time data, but the truth is much simpler than you think, and sadly, most investors overlook it. If you've been doing that too, this video is for you. The world is saturated with information every day. Thousands of analysts and experts pop up telling you to buy this stock or sell that one. TVs, websites, social media, they're all filled with noise and speculation. In the midst of all this, how do you make the best decisions? How do you find stocks truly worth more than their current trading price? Well, this is where most people, unfortunately, go wrong. Most folks chase excitement. They're looking for a stock that'll jump 10% in a week. They're drawn to day trading and quick profits. But I'll tell you, that's not the path to getting rich. That's actually a fast lane to losing your money. Has anyone here ever tried those quick win methods? Ended up disappointed? Share your experiences in the comments below. How do you think I got to where I am by chasing the latest trends and rumors? No, never. My approach is far more boring and straightforward than anything you'd find in news headlines. Yet, this very boring method is what has made the most money for me and my investors. If you're ready to hear the real truth, don't miss the rest of this video. As I've often said, real investing is like buying a great business, not just a piece of paper or a symbol on a screen. When you buy shares in a company, you're essentially owning a piece of that business. So you should look at it as if you intend to buy the entire company and hold on to it for decades. That's the starting point of a completely different perspective. Now, the question is, how do you find those great businesses, especially when their price is less than their true worth? How do you uncover those undervalued stocks before everyone else realizes their real potential? This is the secret I want to share with you today, a secret that seems incredibly simple, yet its execution demands patience and deep understanding. The secret, my friends, boils down to something called value investing. It's not about complex charts, predicting market swings. It's about figuring out what a business is truly worth. Intrinsically, think of it like buying a house. You wouldn't just look at the asking price. You'd check its condition, the neighborhood, potential for rent, right? You'd determine its real value. Stocks are no different. It's about buying a dollar for 50 cents. So how do you figure out this intrinsic value? It's not magic. It involves looking at a company's earnings, assets, its debt management quality, and future earning power. We're interested in businesses that consistently make money, have a durable competitive advantage, something that protects them from rivals, and are run by honest, competent people. What kind of businesses do you personally admire for their solid foundations? Think about it. Once you determine what a business is actually worth, you then wait for its stock price to fall below that value. That's your margin of safety. It's like buying a product on sale. You know, it's full price, you know, it's quality, and when you can get it for less, that's a smart purchase. This margin protects you from errors in judgment. Market volatility, it's what keeps you safe when things inevitably get bumpy. Now, this waiting game is where many investors lose patience. The market is always tempting you with hot tips, quick gains. But real wealth isn't built on chasing fads. It's built on patience and discipline. Think about the last time you saw a really great deal on something you truly needed. Did you jump on it immediately, or did you wait for a better price, knowing its true value? What did that experience teach you? My mentor, Benjamin Graham, taught me that the market is a pendulum. It swings between unjustified optimism, unjustified pessimism. Sometimes it values companies too high, sometimes too low. A smart investor doesn't get caught up in the swings. They use the swings. When the pendulum swings to pessimism, that's when great businesses become undervalued. That's when the opportunities appear. So the secret isn't a complex algorithm or a crystal ball. It's a mindset rooted in common sense. Understand what you own. Buy it for less than it's worth, and then have the patience to hold it. It's about being rational when others are emotional. This sounds simple, but it takes courage to act contrary to the crowd. Have you ever gone against the crowd in any decision and it paid off? Tell me about it. So how do we put this into practice? First, focus on understanding businesses, not just stocks. What do they do? How do they make money? Who are their customers? Is their product or service essential and enduring? I spend a lot of time reading annual reports, industry journals, and even old newspapers. It's about becoming a mini expert in a few areas you truly grasp. Don't try to understand everything. Second, look for companies with a moat. A moat is like a protective castle around a business that guards its profits and market share from competitors. This could be a strong brand like Coca-Cola, unique technology, economies of scale, or high switching costs for customers. A strong moat means the business can consistently earn good returns over time. It's crucial for long-term value. Third, demand a margin of safety. Even after you've found a great business with a wide moat, you shouldn't just buy it at any price. You need to buy it at a significant discount to its intrinsic value. This gives you room for error if your calculation of its worth is a bit off, or if something unexpected happens. That margin protects your capital. It's one of the most important rules. The last and perhaps most difficult step is patience. Once you've bought a great business at a good price, you hold it. You don't sell just because the stock market has a bad week or some analyst downgraded it. You hold it as long as the underlying business fundamentals remain strong. How many of you have ever sold a stock too early only to regret it later? We've all been there. I often say my favorite holding period is forever. Of course, forever isn't always literal, but the mindset is key. Think of it as planting a tree. You don't dig it up every week to check its roots. You plant it, nurture it, and let it grow. Your capital works for you, silently compounding, while you focus on other things. It's a powerful, almost magical force. This approach might seem slow, even boring to some, but remember the fable of the tortoise and the hare. Slow and steady wins the race. The stock market is designed to transfer money from the active to the patient. It's a fundamental truth, so don't rush, understand, buy well, and then simply wait. Your biggest enemy in investing is often yourself and your own impatience. Now, just as important as knowing what to do is knowing what not to do. Avoid businesses you don't understand. If you can't explain what a company does to a 10-year-old, you probably shouldn't invest in it. This sounds overly simple, right? But it protects you from chasing fads or investing in complex schemes you barely grasp, which is a common trap. Your circle of competence is your best friend. Also, don't get hung up on daily news or quarterly earnings reports. The market reacts wildly to every little piece of news. But a great business rarely changes its fundamental value overnight. Focus on the long-term story. If the underlying business is still performing well, making profits, and serving its customers, temporary market fluctuations are just noise. Does anyone feel overwhelmed by the constant news cycle about the market? Another mistake is trying to time the market. People constantly try to buy at the absolute bottom, sell at the absolute top. It's impossible. Even I don't try to do that, and neither should you. The goal isn't to buy at the perfect moment. It's to buy a wonderful company at a fair price and hold it. Trying to time the market is a fool's game that guarantees you'll miss out on gains and incur more costs. And Please avoid leverage, borrowing money to invest. While it can amplify gains, it also dramatically amplifies losses. When you borrow money, you add a layer of risk that can wipe you out, especially during market downturns. True wealth is built on solid ground, not on borrowed time or borrowed money. What's your biggest fear when it comes to managing your personal finances? Share your thoughts. Simplicity is key. Many people get intimidated by investing because they think it's inherently complicated. They see all the jargon and fancy theories and decide it's not for them. But my approach and what I believe to be the most successful is fundamentally simple. It doesn't require a genius IQ, just a solid understanding of business and human behavior. If you understand the basics of accounting, how a business generates profit, and what makes a company durable, you're already ahead of most people. Don't let complexity scare you away from what can be an incredibly powerful tool for your financial future. It's about clarity, not complexity. What's one financial term you found confusing, but now understand better? Ultimately, finding undervalued stocks and building wealth is a long-term game. It's not about what the market does next week, but what a solid business will do over the next decade. Think of your investments as your little army of money, working tirelessly for you, compounding year after year. The greatest magic of compounding happens over long periods, so time is your most valuable asset. So don't get discouraged by short-term market fluctuations. They're just noise. If you own a piece of a great business that's well managed and financially sound, you'll do just fine over time. Your focus should always be on the performance of the business itself, not the daily ticker tape. What helps you stay calm when the market gets volatile? Share your strategies. Remember, investing is not about being smart enough to predict the future. It's about having the discipline to stick to sound principles, find businesses you understand that have a durable competitive advantage, run by honest managers, and buy them when their price is below their intrinsic value. And this is the hardest part for many, do almost nothing. The market has a wonderful way of eventually recognizing true value. It might take months, it might take years, but if you've done your homework and bought $1 for 50 cents, eventually that 50 cents will be recognized as $1 or even more. That's the secret. It's simple, it's boring, and it works consistently over time. I encourage you to start applying these principles in your own investing journey. Begin with understanding, move to analysis, demand a margin of safety, and then embrace patience. It's not about being quick, it's about being right. And remember, the best investment you can make is an investment in yourself. And so keep learning, keep growing. Thank you for joining me on Buffett's Compass today. I hope these insights help you navigate the markets with more confidence and clarity. Don't forget to subscribe for more timeless wisdom from the world of investing. Share this video if you found it valuable, and let me know in the comments below what other investing topics you'd like me to discuss next. Until next time, stay wise and patient.